I would forecast gold to be at $10,000 an ounce. The not too distant future, whether that's mid-2027, late 2027, but sooner than later. When I say that, people go, wait a second, Jim, that's crazy, you know. But what they don't realize is that as gold goes up, now here we're in another behavioral bias. It's called anchoring. We tend to anchor on a number, which gives it a comfort level. So let's just take $1,000 an ounce increase, and you own 50 ounces, let's say. Gold goes from $2,000 to $3,000 an ounce. You just made $50,000, 50 times 1,000. And if it goes from $3,000 an ounce to $4,000 an ounce, you made another $50,000. So people anchor on the $1,000 and the $50,000 in that step-like pattern. But what they don't realize, at least not right away, each $1,000 increment is easier than the one before.
Global monetary architecture is experiencing intense macroeconomic friction as physical bullion accumulation accelerates across institutional markets. Conventional portfolio models routinely underestimate how swiftly tangible assets reprice once historic valuation ceilings dissolve. Jim Rickards, seasoned economist and macro strategist, projects gold surging to $10,000 per ounce by mid to late 2027. He illustrates that behavioral price anchoring leads mainstream observers to misjudge upward velocity, treating each $1,000 increment as an identical barrier. In reality, compounding baselines compress the required percentage effort. Advancing from $3,000 to $4,000 represents a heavy 33% climb, but moving from $9,000 to the ultimate $10,000 target requires just an 11% shift, a move easily matched by standard weekly market volatility. Because higher nominal starting values reduce the necessary percentage gain, bullion will accelerate rapidly through the upper tiers, conquering final price targets far faster than consensus expectations. Now, we present the clips from Jim Rickards' interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you and enjoy the video.
Gold went from $35 an ounce to $800 an ounce, a 2,300% increase between 1971 and 1980. Entered a almost 20-year bear market, mostly sideways, not a collapse, but it bottomed out in 1999 at about $250 an ounce. That's when Gordon Brown sold almost half of England's gold, the Brown's bottom, as they call it, because he managed to pick the bottom of the market. From there, we went into an enormous bull market from 1999 to August 2011 was the peak. Gold hit $1,900 an ounce. That was a 670% increase. Okay, then we got into the second bear market. Gold between August 2011 and December 2015 fell from $1,900 an ounce to $1,050 an ounce. Now, what's the significance of that 1050 bottom in December 2015? I talked to Jim Rogers about this, and you may know Jim. Yep. He's the greatest commodities trader in history. This was around 2016, somewhere in there. But gold was going down. And he said, I'm not selling any gold. I said, I'm not buying a lot at the moment, but I'm not selling it. He said, here's the thing, Jim. No commodity goes to the moon without a 50% drawdown along the way. And if you're not ready for that and you're not prepared for that, you're in the wrong market. Well, I took that to heart and I looked at the numbers, and when you do this kind of calculation, you need a base. So I took the base of $250 an ounce in 1999 because that was the bottom. You go up to $1,900 an ounce in August 2015. Divide that difference in half, subtract from 1,900, guess what you get? It's like 1070. I mean, Roger stuck the landing. It was 1050, $20, big deal. He completely stuck the landing. He completely forecast what was going to happen. But then it went from there to $5,500 an ounce in a second great bull market with a lot of volatility along the way. Now, what's going on now? It's the same thing, and here we get into fractal mathematics, Mandelbrot basically, and he discovered something called a scale invariance. And what that means is that if I gave you two stock market charts with ups and downs, usual patterns, etc., and one was a 10-year chart and one was a 10-week chart, but I covered up the dates and the index. I just showed you the chart. They would look the same. In other words, in any fractal system, the patterns are the same at every scale. So no matter how much you put under the microscope, you see the same pattern at a smaller scale. So again, taking what Jim Rogers explained to me and what we saw in that 4-year bear market between 2011 and 2015, I said, okay, let's do it again. And I picked a base of around 1,800. That was about 3 years ago. It wasn't that long ago. It was kind of languishing around 1,800. I ran it up to 5,400, which was the peak. It depends what ticker you look at, but 5,400 an ounce. Again, take half the difference, subtract it from 5,400, and where are you? Well, the answer is about 3,600 an ounce. So that doesn't mean it goes to 3,600, but what I said was 3,600 looks to me like a pretty hard floor. It got down to 3,900. It would, okay, a little bit different. But when I said 3,600 looks like a hard floor based on the pattern that Jim Rogers described and Mandelbrot's idea of scale and variance. It got to 3,900 and it's been going up ever since. So I think we've had our test. It was never a peak. It is a drawdown. It conformed to Mandelbrot and Jim Rogers. That's a pretty good analytical team. And now it's heading much higher. I would forecast gold to be at $10,000 an ounce in the not too distant future, whether that's mid-2027, late 2027, but sooner than later. And when I say that, people go, wait a second, Jim, that's crazy, But what they don't realize is that as gold goes up, now here we're in another behavioral bias. It's called anchoring. We tend to anchor on a number, which gives it a comfort level. So let's just take $1,000 an ounce increase, and you own 50 ounces, let's say. So if gold goes from $2,000 to $3,000 an ounce, you just made $50,000, 50 times 1,000. And if it goes from $3,000 an ounce to $4,000 an ounce, you made another $50,000. So people anchor on the $1,000 and the $50,000 in that step-like pattern. But what they don't realize, at least not right away, is that each $1,000 increment is easier than the one before, because you're working off a higher base, so it's a smaller percentage gain, even though it's the same $1,000 gain. So by anchoring on the 1,000, so when you go from $3,000 to $4,000 an ounce, that's a 33% increase. That's a heavy lift. But when you go from $4,000 to $5,000 an ounce, that's a 25% increase. That's easier. Now, when you go from 9,000 to 10,000, that's only an 11% increase, which is like a week's volatility these days. So my point is, gold's going to, it's going to chug back a little engine that could get back to $5,000, make its way to $6,000. But it's going to go 7, 8, 9, 10 really fast, much faster than people expect, for the reason I mentioned, which is every one of those benchmarks is easier than the one before.
Financial market charts exhibit scale and variance through fractal mathematics, revealing identical structural patterns across both multi-year and multi-week timeframes. Long-term commodity cycles dictate that no asset advances without absorbing a rigorous 50% drawdown along the journey. Historical trends confirm this exact rhythm, spanning the 2,300% expansion between 1971 and 1980, the 1999 cyclical low at $250, and the 2015 bottom near $1,050. When evaluating previous runs from $1,800 to $5,400, mathematical modeling established a firm structural floor near $3,600, perfectly matching the realized rebound at $3,900. Far from signaling a cyclical market top, this textbook retracement preserved structural integrity, successfully validating institutional support across the broader supercycle. Now, let's get back to the interview.
There's no prospect of a gold standard. That's not going to happen. All this talk about the Chinese gold-backed yuan is nonsense. China is accumulating enormous amounts of gold. There's no question about it. But if you look at even the high estimates of the amount of gold they have relative to GDP, it's 1 or 2%. And if you look at the same number relative to their money supply, same thing. Now, the United States is about 7 or 8%. Russia is actually the highest in the world. It's about 12, a little over 12%. But no, China has, even with all the accumulation and like giving a high end of the estimates, China has nowhere near enough gold to support the yuan, number one. Number two, people don't understand reserve positions. They say, the dollar is the leading reserve currency of the world, et cetera, et cetera. Currencies are not reserves at all. Securities are reserves. They're denominated in dollars, but the People's Bank of China doesn't have $100 bills stacked on pallets in the basement. They own U.S. Treasury securities. Now, yes, they are denominated in dollars, but a security is not a dollar and it's not cash. You actually have to sell the Treasury to get cash if you want cash. And that's what Japan's doing. We talked about that a little bit earlier. So the key to being a so-called reserve currency is not so much the currency, it's the securities market. Do you have a big enough sovereign bond market to absorb the amount of savings that want to go into any asset, but basically any asset? The answer is the only market big enough is the U.S. Treasury market. Now, the other big bond markets in the world are Japan and Italy. Okay. Germany to a lesser extent, sterling to a lesser extent. But when you look at the actual breakdown, again, in securities, but denominated in certain currencies, the dollar is about 59%, the euro is about 28%. So you've got 80%, almost 90% of the market in just the dollar and the euro, predominantly the dollar. All the other currencies, sterling, Canadian dollar, Aussie dollar, Chinese yuan, Japanese yen, etc., Swiss franc, they make up the other 10%, little 1 or 2% slivers. So you got to bear that in mind. But then, okay, well, what's the big deal? Let's just get a Chinese bond market going. Good luck. It would take at least 10 years, maybe 15 years, to get a sovereign bond market going, because it's not just issuing debt. By the way, China does not have a significant sovereign bond market today. Gold has surpassed U.S. Treasuries as the leading reserve asset, which was a true statement. But it was not because everyone was dumping treasuries. That was the debasement trade, or they call it the debasement trade. It was not because of that. It was because the price of gold went up so much. If you had the same amount of gold, the same amount of treasury, the price of gold went up. So yeah, gold by dollars. Interesting how we always come back to dollars, right? Gold by dollars, or denominated in dollars by weight, is larger than U.S. Treasuries, but it was because the price of gold went up. It was not because they were buying so much gold. Now, central banks have been net buyers of gold since 2010. From 1970 to 2010, they were net sellers, and since 2010, they've been net buyers. Now that puts an important floor under the gold market. By the way, I'm very bullish on gold. I mean, don't get me wrong, but you like to get your facts straight, and for the viewers. And gold is a very attractive asset. I recommend it. I own it myself, and the central bank buying puts a really nice floor under it. The other things that will drive it higher, it has been moving inversely to oil prices. That's not always true, but it has been true now. So oil prices go up, gold goes down. Recently, oil prices went down a little because of what we talked about earlier with Trump saying the war's over in 2 days, and gold went up. It's up. I think I looked at the ticker. It was like close to 4,400, which is that's a 10% pop from the $4,000 an ounce level. So I'm very bullish on gold, and I do recommend it for asset allocation. But I think you have to be realistic about what's going on in the Treasury securities market. It's not going anywhere.
Speculation regarding an immediate gold-backed Chinese yuan overlooks the core mechanisms governing international reserve architecture. True foreign exchange reserves consist of deep, highly liquid sovereign bond markets capable of absorbing immense global capital, rather than physical currency notes. The United States Treasury ecosystem dominates international reserves at roughly 59%, while European debt accounts for 28%. Other currencies, including the yuan, yen, and sterling, make up narrow slivers of the remaining 10%. Developing a sufficiently deep sovereign bond infrastructure in China would require at least a decade to 15 years. Furthermore, Chinese bullion holdings represent merely 1 to 2% of gross domestic product and national money supply, compared to 7 to 8% in the United States and over 12% in Russia. Gold's expanding valuation among global reserves stems from rapid capital appreciation rather than outright treasury dumping. Continuous net accumulation by central banks since 2010 provides an enduring institutional price floor, while short-term inverse trading dynamics against crude oil supply introduce additional upside catalysts. These fundamental macroeconomic conditions reinforce physical bullion as a foundational asset for long-term portfolio diversification. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.